America's daily interest burn now tops $2.6 billion, more than what most countries spend on entire defense budgets. The global financial order is quietly cracking as America's debt has exploded past $36 trillion in 2025. That figure tops a year of US GDP twice over and outstrips the entire economies of Europe and Africa combined. For the first time in decades, the world's biggest creditors are backing away. China has dumped hundreds of billions in US bonds. Japan is selling. Even European allies are reducing their holdings. This isn't just about numbers on a spreadsheet. When foreign countries stop buying American debt, the ripple effects could reshape everything from your mortgage rates to global trade. But to understand why this matters so much, we need to examine what that $36 trillion really represents. The $36 trillion breaking point. That figure represents something economists have been dreading for years. We've crossed a line that separates manageable debt from something far more dangerous. This isn't just another milestone. It's a psychological barrier that changes how the world sees America's financial stability. To put this in perspective, $36 trillion is larger than the GDP of every major region combined, Europe and Latin America, and more than 6 times Japan's GDP. That's not an exaggeration. This debt represents a real obligation. Real money that must be paid back with interest to real creditors who expect their payments on time. This isn't monopoly money or accounting tricks. Foreign governments, pension funds, and financial institutions around the world hold these bonds expecting America to honor every cent. The debt-to-GDP ratio tells an even more disturbing story. America's debt hit 124% of its entire economic output in 2024. The ratio last topped 100% in 2013, and it's been climbing steadily since. Back then, there was hope that economic growth would eventually bring the numbers back under control. Instead, the gap has only widened. Today's situation is fundamentally different from past debt crises. There's no world war to justify this level of borrowing, no existential threat that required mortgaging the future. Instead, this debt accumulated during peacetime through decades of spending more than the government collected in taxes. Year after year, administration after administration, the bills kept piling up. The mathematics of the current trajectory reveal something frightening. At the current pace, America adds roughly $2 trillion in new debt every year. That's $5.5 billion every single day. To service this debt, the government must find buyers for new bonds constantly. If economic growth continues at its historical average of around 2% annually, but debt grows at 6% annually, the gap widens exponentially. Within a decade, debt could reach $50 trillion. Within 2 decades, $70 trillion. These calculations aren't lost on foreign creditors. Financial ministers in Beijing, Tokyo, and European capitals run the same numbers. They see the same mathematical impossibility. When you owe money to someone, they tend to pay attention to your ability to pay it back. And increasingly, those calculations are making foreign investors nervous. The interest payments alone now consume over $1 trillion annually from the federal budget. That's more than America spends on education, transportation, and scientific research combined. It's approaching what the country spends on defense. Every percentage point increase in interest rates adds roughly $360 billion to annual payments. When rates were near zero, this seemed manageable. Now that rates have risen above 5%, the numbers become staggering. This creates a vicious cycle that economists call a debt trap. Higher debt levels make investors demand higher interest rates to compensate for increased risk. Higher rates mean higher interest payments. Higher payments mean more borrowing to cover the costs. More borrowing means even higher debt levels. The cycle feeds on itself until something breaks. Previous debt crises happened during clear emergencies. The Civil War, 2 world wars, the Great Depression, even the 2008 financial crisis. Each time, Americans understood why their government needed to borrow heavily. There was an enemy to defeat, an economy to rescue, or a financial system to save. Once the crisis passed, debt levels typically declined. This time is different. The debt exploded during what historians will likely remember as a period of relative peace and prosperity. No major war threatened national survival. No economic depression required massive stimulus. Instead, the debt grew because politicians found it easier to promise benefits than to raise taxes or cut spending. Every year, they pushed the hard choices to future generations. Foreign creditors are starting to question whether America has the political will to make those hard choices. They watch congressional battles over the debt ceiling and see a country that can't even agree on basic fiscal responsibility. They observe politicians who promise to cut spending while simultaneously proposing expensive new programs. They notice that every attempt at deficit reduction gets abandoned when voters complain. The foundation of global finance has rested on one simple assumption for decades. America always pays its debts. American bonds are the safest investment in the world. The dollar is the most reliable store of value. These beliefs created a system where countries around the world were eager to lend money to the US government at relatively low interest rates. But foundations can crack. When debt reaches levels that seem mathematically impossible to repay, when interest payments consume ever larger portions of the budget, when political dysfunction prevents serious reform, confidence begins to erode. The erosion starts slowly, almost imperceptibly. A few countries reduce their holdings. Interest rates tick up slightly. Bond auctions attract fewer bidders. Then the cracks spread faster. More countries sell their holdings. Rates rise further. New debt becomes more expensive to issue. The government needs to borrow more just to pay the higher interest costs. Foreign investors become more selective about which American bonds they'll buy. Some stop buying altogether. We've moved beyond the realm where traditional economic models provide reliable guidance. Most economic theories assume that governments will act rationally to avoid fiscal crisis. They assume that democratic systems will make necessary adjustments before reaching dangerous debt levels. They assume that the threat of financial collapse will force political compromise. None of these assumptions seem to hold anymore. America has entered uncharted territory where the normal rules of fiscal responsibility have been suspended. The debt continues growing faster than the economy. Political leaders continue promising more spending while refusing to raise sufficient revenue. Foreign creditors continue expressing concern while American politicians dismiss their warnings. The $36 trillion threshold represents more than just another big number. It marks the point where America's debt has become so large that it fundamentally changes the country's relationship with the rest of the world. No longer is America the unquestioned safe haven for global savings. Instead, it's become a debtor nation whose ability to honor its obligations increasingly depends on the continued faith of foreign creditors. That faith is starting to waver, and some of America's biggest creditors aren't just losing confidence. They're taking action that looks suspiciously like a coordinated strategy to exploit this weakness. China's financial warfare strategy. Beijing has been executing a calculated financial strategy that looks exactly like economic warfare. Since 2021, China has systematically reduced its holdings of US Treasury bonds, selling off massive positions in what appears to be a coordinated campaign to undermine American financial stability. The numbers reveal the scale of this operation. China's Treasury holdings have dropped to $756.3 billion as of May 2025, down from over $1 trillion just a few years earlier. This represents the lowest level since February 2009, when China held $744.2 billion in US debt. The timing of these sales reveals the strategic nature of China's actions. Every major escalation in US-China tensions has been followed by accelerated bond selling. When the US banned Chinese technology companies, China dumped treasuries. When tariffs increased, more bonds hit the market. When military tensions rose over Taiwan, selling intensified. This isn't coincidental market behavior. It's deliberate financial pressure designed to increase America's borrowing costs and signal to other countries that US debt isn't the safe haven it once appeared to be. China's approach represents a sophisticated understanding of America's vulnerabilities. By slowly reducing their treasury holdings, they avoid triggering immediate market panic while steadily increasing pressure on US bond markets. The Chinese know that sudden massive sales would crash their own holdings value, so they've chosen a more strategic approach. They sell enough to send a message and influence market sentiment, but not so much that they destroy the value of their remaining positions. The geopolitical implications become clear when you examine how China uses these sales as leverage. During trade negotiations, Chinese officials have made subtle references to their treasury holdings, implying that cooperation depends on American behavior. When territorial disputes arise in the South China Sea, treasury sales often follow diplomatic protests. China has effectively turned America's own debt into a bargaining chip, using it to extract concessions and signal displeasure without firing a shot. What makes this strategy particularly dangerous is that China still holds enough US debt to cause serious market disruption if they chose to sell rapidly. Their current holdings of $756.3 billion represent enormous potential market impact. If China decided to liquidate these positions quickly, it would flood the treasury market with supply, driving down bond prices and forcing interest rates higher. The mere possibility of such action gives China significant leverage over American policy decisions. China's strategy extends beyond simply selling US bonds. They're simultaneously building alternatives to dollar-based systems. Chinese gold holdings reached 73.83 million ounces by the end of May 2025, representing a massive accumulation of precious metals as a dollar alternative. They're also promoting yuan-denominated trade agreements with other countries, creating financial infrastructure that bypasses the dollar entirely. This two-pronged approach weakens demand for U.S. debt while building competing systems. The feedback loop this creates is particularly troubling. As U.S.-China tensions rise, China sells more treasuries. Higher treasury sales increase U.S. borrowing costs. Each 1% rate rise adds roughly $360 billion a year according to Congressional Budget Office projections, compounding the trap. Higher borrowing costs strain the U.S. budget. Budget strain leads to more confrontational policies toward China to appease domestic audiences. More confrontational policies lead to higher tensions. The cycle accelerates, with each escalation driving more financial pressure. China's diversification efforts reveal the long-term nature of their strategy. Officials describe their treasury sales as part of a broader plan to reduce concentration risk in their foreign exchange reserves. This sounds like prudent financial management, but the timing and scale suggest something more calculated. China is methodically reducing their exposure to American financial dominance while building alternative systems that could eventually challenge the dollar's global role. The strategic implications extend beyond bilateral relations. China's actions serve as a model for other countries seeking to reduce their dependence on American financial systems. When the world's second-largest economy demonstrates that you can gradually move away from U.S. treasuries without immediate consequences, it encourages similar behavior from other nations. Several countries have already begun following China's lead, reducing their own dollar reserves and exploring alternative arrangements. The accumulation of gold deserves particular attention because it represents a direct challenge to the dollar-based system. Gold has historically served as an alternative store of value during periods of currency instability. By accumulating massive gold reserves while reducing dollar holdings, China is preparing for a potential future where the dollar's dominance has declined. This isn't just about diversification. It's about building the foundation for a post-dollar international monetary system. Chinese financial institutions have received clear guidance to reduce their dollar exposure across multiple asset classes. This goes beyond government treasury holdings to include corporate bonds, bank deposits, and other dollar-denominated investments. The scope of this rebalancing suggests a comprehensive strategy to insulate China's financial system from potential dollar volatility, while simultaneously increasing that volatility through reduced demand. The messaging around these moves is carefully crafted to appear reasonable while carrying implicit threats. Chinese officials speak about prudent risk management and portfolio optimization rather than admitting to financial warfare. This language provides plausible deniability while making the strategic intent clear to informed observers. They're reducing exposure to American debt because they consider it increasingly risky, which becomes a self-fulfilling prophecy as other investors reach similar conclusions. What makes China's approach particularly effective is its patience. Unlike previous challenges to American financial dominance, China isn't trying to trigger an immediate crisis. Instead, they're gradually eroding the foundations of the dollar system while building alternatives. This long-term approach is harder to counter because it doesn't create obvious moments for American retaliation. By the time the damage becomes apparent, the process may be too advanced to reverse. China has successfully weaponized America's own debt against it in a way that no previous rival managed to achieve. They've turned the U.S. government's need for foreign financing into a source of leverage and vulnerability. The beauty of this strategy from China's perspective is that it uses America's fiscal irresponsibility as the weapon, making it difficult for the U.S. to respond without addressing the underlying debt problem that created the vulnerability in the first place. But China's financial warfare represents only part of a much larger problem. The real shock isn't coming from America's adversaries. The domino effect among allies. America's closest allies are quietly stepping back from their historical role as reliable buyers of U.S. debt. These are the countries that stood with America through decades of global challenges, the nations whose financial ministers once competed to buy treasury bonds at every auction. Their changing behavior signals something far more dangerous than routine portfolio adjustments. Japan has served as America's most dependable creditor for decades, consistently holding more U.S. treasuries than any other foreign nation. With $1.135 trillion in holdings as of May 2025, Japan remains the largest foreign holder of American debt. But beneath these headline numbers lies a more complex story. Japanese officials have become increasingly vocal about their concerns regarding America's fiscal trajectory. Their recent 3% increase in holdings since May 2024 represents the smallest growth rate in years, suggesting a more cautious approach to new purchases. Japanese pension funds, which manage trillions in retirement savings, have started questioning whether U.S. treasuries deserve their traditional safe haven status given America's deteriorating fiscal position. The shift becomes more pronounced when examining Japan's internal policy discussions. Bank of Japan officials have quietly begun exploring alternatives to dollar-denominated reserves. Their meetings with European counterparts increasingly focus on diversification strategies that reduce dependence on American debt. Japanese financial institutions report growing pressure from regulators to limit their exposure to any single sovereign debtor, even one as historically reliable as the United States. European allies present an even more concerning pattern. The United Kingdom increased its holdings to $809.4 billion in May 2025, an 11% jump that pushed them past China as the second-largest foreign holder. This surge to an all-time peak might seem reassuring, but financial analysts suspect much of this increase comes from hedge funds and private investors using London as a base, rather than genuine British government confidence in American fiscal health. The Bank of England has simultaneously been reducing its own direct Treasury positions while private entities increase theirs, suggesting official skepticism even as overall UK-based holdings rise. Germany's approach reveals the tensions within the European alliance system. German finance ministers have expressed private concerns about America's ability to maintain fiscal discipline while publicly supporting continued cooperation. Their Treasury purchases have become more selective, focusing on shorter-term bonds that offer easier exit opportunities. This shift toward shorter maturities indicates German officials want to maintain flexibility to reduce their exposure quickly if America's fiscal situation deteriorates further. Canada's behavior exemplifies the uncertainty among allies. Their holdings jumped 21% to $430.1 billion in May 2025, reversing a significant selling spree in April when Canada dumped massive quantities of U.S. debt. This volatile pattern suggests Canadian officials are struggling to develop a consistent strategy for managing their American exposure. One month they're major sellers, the next month they're aggressive buyers. This inconsistency reflects deeper uncertainty about America's fiscal future and Canada's role in supporting it. The diplomatic pressure behind these numbers tells a more troubling story. American Treasury officials have been conducting unprecedented outreach to allied governments, essentially lobbying them to maintain their Treasury purchases. These conversations, once routine and cordial, have become more urgent and pointed. Treasury Secretary meetings with foreign counterparts now include explicit discussions about the strategic importance of continued allied support for American debt markets. Rising interest rates in allied countries have fundamentally altered the investment landscape. When European central bank rates reached 4.5% and Bank of Japan rates moved away from negative territory, their domestic bonds became competitive alternatives to U.S. Treasuries. German bonds offering 3.2% returns suddenly looked attractive compared to 10-year U.S. Treasuries, yielding 4.1%, especially when currency risks and America's fiscal concerns are factored into the calculation. The strategic implications become clear when military alliances start affecting financial relationships. NATO allies find themselves in the awkward position of questioning the fiscal health of the alliance's primary funder while depending on American military protection. This creates unprecedented tensions where security cooperation must be balanced against financial prudence. Allied defense ministers privately worry that America's debt burden could eventually limit its ability to maintain global military commitments. Belgium's 33% increase in holdings to $415.5 billion reflects these complex dynamics. Belgian officials describe their purchases as supporting alliance solidarity, but they've simultaneously imposed stricter limits on future acquisitions. Their finance ministry has established debt-to-GDP thresholds that would trigger automatic reductions in U.S. Treasury holdings if America's fiscal metrics continue deteriorating. France's holdings rose by 33% to $375.1 billion, but this increase came with explicit conditions about American fiscal responsibility that hadn't been part of previous arrangements. The most dangerous aspect of this shift is how it forces America to depend on less reliable creditors. As traditional allies become more selective about their purchases, American debt markets must attract buyers from countries with different motivations and loyalties. Sovereign wealth funds from the Middle East have increased their purchases, but their support comes with implicit expectations about American foreign policy in their regions. Asian nations outside the traditional alliance structure have stepped up their buying, but their long-term commitment remains uncertain. This dependence on fair-weather creditors creates vulnerabilities that didn't exist when core allies provided the bulk of foreign demand. The reliability that once characterized foreign demand for U.S. debt has been replaced by conditional support that could evaporate during times of crisis. Allied governments face increasingly difficult questions from their own citizens about why taxpayer funds should support American borrowing when domestic needs go unmet. The coalition that built and sustained American financial dominance for 7 decades is quietly fragmenting. Allies who once competed to support American borrowing now compete to limit their exposure while maintaining plausible deniability about their changing loyalties. The unquestioned faith that made foreign governments eager buyers of U.S. debt has been replaced by careful calculation and conditional support. As foreign demand weakens and becomes less predictable, America faces a brutal mathematical reality that grows more expensive with each passing day. Interest rate death spiral. The government now burns through $2.6 billion every single day just to service its existing debt. That's not paying down the principal. That's not funding new programs. That's simply the cost of having borrowed money in the past. America spends more on interest payments in a single day than most countries spend on their entire annual budgets. This daily burn rate has exploded compared to previous years. Just 5 years ago, when interest rates averaged 1.753% on the total marketable debt, daily payments were roughly half what they are today. The average interest rate has climbed to 3.375% as of June 2025, up from 3.344% just 1 year earlier. This seemingly small increase translates to billions in additional costs, because the rate applies to the entire $36 trillion debt load. Every percentage point increase in interest rates adds approximately $360 billion to America's annual borrowing costs. When rates were near zero during the pandemic, this seemed manageable. Politicians could borrow trillions for stimulus programs while paying minimal interest. But as the Federal Reserve raised rates to combat inflation, those rock-bottom borrowing costs disappeared. Each quarter-point rate hike by the Fed now costs taxpayers tens of billions annually in higher interest payments. The scale becomes more disturbing when compared to other government spending categories. Interest payments have already surpassed defense spending, which totaled $816 billion in fiscal 2024. America now pays more to service its debt than it spends on the entire military, including weapons procurement, personnel costs, and overseas operations. This represents a fundamental shift in national priorities, where past borrowing decisions consume resources that could otherwise strengthen national security. Interest costs have also exceeded Medicare spending, making debt service the third largest category in the federal budget. Only Social Security and overall health programs consume more taxpayer dollars than the simple cost of paying interest on money borrowed years or decades ago. This means America spends more servicing old debt than it does providing health care to seniors or maintaining the social safety net that millions depend on. The vicious cycle this creates is mathematically unstoppable under current policies. Higher debt levels make investors demand higher interest rates to compensate for increased risk. Those higher rates increase the government's borrowing costs, requiring more debt to fund the same operations. Additional borrowing pushes total debt even higher, which further increases investor concerns about repayment ability. The cycle feeds on itself, accelerating with each iteration. Projections for the next decade reveal how quickly this spiral could consume the entire federal budget. The Congressional Budget Office estimates that net interest payments will total $12.9 trillion over the next 10 years, increasing from $1 trillion annually in 2025 to $1.7 trillion by 2034. By 2035, daily interest costs are projected to reach $4.9 billion. That's nearly double the current rate in just a decade. As a percentage of total federal spending, interest payments are forecast to reach 15.8% by 2032. This would surpass the previous record of 15.4% set in 1996, when America last faced a serious debt crisis. The difference is that the 1990s crisis occurred with much lower absolute debt levels and during a period of strong economic growth that helped resolve the problem. Today's crisis is happening with debt levels 3 times higher and much slower projected growth rates. These escalating interest costs crowd out spending on everything else the government does. Every $1 billion spent on interest payments is $1 billion that can't be invested in crumbling infrastructure, scientific research, education, or social programs. Roads don't get repaired because the money goes to bondholders instead. Schools don't get updated technology because interest payments take priority. Medical research gets cut because debt service consumes available funds. At current trajectories, interest payments could theoretically consume the entire federal budget within several decades. If debt continues growing at 6% annually while the economy grows at 2%, and if interest rates remain elevated, the mathematics become impossible. Even if the government eliminated every other category of spending, including defense, Medicare, and Social Security, the interest payments alone would exceed total federal revenues. This mathematical prison makes America increasingly vulnerable to any economic shock or financial crisis. During recessions, tax revenues typically fall while spending on unemployment benefits and other safety net programs increases. In the past, America could borrow its way through these temporary challenges, confident that economic growth would eventually restore fiscal balance. But with such high existing debt levels and massive interest payments, there's little room for additional borrowing during the next crisis. The Federal Reserve faces an impossible dilemma in this environment. If inflation resurges, they need to raise interest rates to combat it. But higher rates directly increase government borrowing costs, making the debt problem worse. If they keep rates low to help the government manage its debt burden, they risk allowing inflation to spiral out of control. Either choice leads to economic damage, and the Fed's traditional tools become counterproductive. Foreign creditors understand these dynamics and factor them into their investment decisions. When they see America trapped in a debt spiral where rising interest costs require ever more borrowing, they naturally become more cautious about lending additional money. This caution leads to higher interest rates, which accelerates the very spiral that concerns them. Their rational response to America's fiscal problems makes those problems worse. The speed at which this crisis could unfold surprises many observers who assume debt problems develop gradually over decades. But in modern financial markets, confidence can evaporate rapidly. If investors suddenly decide that America's debt trajectory is unsustainable, interest rates could spike quickly, making the crisis self-fulfilling. Daily interest costs could jump from $2.6 billion to $4 billion or $5 billion almost overnight if bond markets lose confidence. America has constructed a mathematical prison where escape becomes more difficult with each passing day. The interest rate death spiral operates according to inexorable mathematical laws that don't respond to political speeches or diplomatic pressure. But the real danger isn't just the mathematics of rising interest costs. The entire system that allows America to borrow at relatively low rates depends on something far more fragile than numbers. The dollar's cracking foundation. That foundation rests on trust, and trust can disappear faster than most people realize. For nearly 8 decades, the entire world economy has operated on one basic assumption: dollars are safe, dollars are stable, dollars will always be accepted everywhere. This belief created a system where central banks from Tokyo to London to Berlin kept massive reserves in US currency, confident that these holdings would maintain their value regardless of what happened in their domestic economies. Every international trade transaction relies on this dollar foundation. When Saudi Arabia sells oil to Japan, they price it in dollars. When Germany buys soybeans from Brazil, the contracts are denominated in dollars. When China exports electronics to Europe, the payments flow through dollar-based banking systems. This universal acceptance gives America enormous advantages that most citizens never think about. The system works because other countries need dollars to participate in global trade. They accumulate these dollars by selling goods and services to America or by attracting American investment. Then they store these dollars in the safest possible place, US Treasury bonds. This creates constant demand for American debt and allows the US government to borrow at lower interest rates than would otherwise be possible. But central banks worldwide are quietly changing their behavior in ways that threaten this entire arrangement. The diversification started slowly and received little attention from financial media. Russian sanctions in 2022 provided the initial wake-up call when Western governments froze Russian dollar reserves overnight. Central bankers in other countries watched this happen and realized that their own dollar holdings could face similar risks if their governments ever disagreed with American foreign policy. China began the most aggressive diversification campaign. Their central bank reduced dollar reserves from 65% of total holdings in 2015 to approximately 58% by early 2025. This might seem like a modest shift, but when applied to China's $3.2 trillion in foreign exchange reserves, it represents hundreds of billions of dollars moving away from dollar-denominated assets. Chinese officials describe this as prudent risk management, but the timing coincides perfectly with deteriorating US-China relations. The People's Bank of China has simultaneously increased gold purchases to record levels. Their official gold reserves reached 73.83 million ounces by May 2025, up from 62.64 million ounces just 2 years earlier. This represents $174 billion worth of gold accumulation during a period when they were selling US Treasury bonds. The message is clear. China is replacing dollar assets with physical gold that no foreign government can freeze or sanction. European central banks are following similar strategies with less fanfare. The European Central Bank has been quietly reducing the dollar's share of its reserves while increasing euro and gold holdings. Individual European nations are making even more dramatic changes. The The Bundesbank, Germany's central bank, has repatriated massive amounts of gold from foreign vaults and increased domestic storage capacity. French officials have openly discussed the need to reduce dependence on dollar-based payment systems. Digital currencies represent the most significant long-term threat to dollar dominance. China's digital yuan now processes over $250 billion in annual transactions, creating an alternative payment system that bypasses traditional dollar-based banking. The European Union is developing a digital euro that could facilitate trade between member nations without involving American financial institutions. Russia and Iran have created bilateral digital payment systems that eliminate dollars from their trade relationship entirely. These digital alternatives gain importance because they offer something the current system lacks: independence from American financial oversight. When countries trade using dollars, those transactions typically flow through American banks and payment processors. This gives U.S. regulators visibility into global commerce and the ability to block transactions they consider problematic. Digital currencies allow countries to trade without this American intermediation. America's aggressive use of financial sanctions has accelerated the search for alternatives. When the U.S. government froze Russian reserves and expelled Russian banks from the SWIFT messaging system, it demonstrated that dollar holdings could become worthless overnight if Washington disapproved of a country's actions. This lesson wasn't lost on other nations, including American allies who worry they could face similar treatment if their policies ever diverged significantly from Washington's preferences. Losing reserve currency status would devastate ordinary Americans in ways most people don't understand. When foreign central banks hold fewer dollars, it reduces demand for the currency. Lower demand means a weaker dollar relative to other currencies. A weaker dollar makes imports more expensive, and America imports enormous quantities of goods that would suddenly cost more. The government's borrowing costs would increase dramatically. America currently benefits from what economists call an exorbitant privilege, where other countries accept lower returns on dollar investments because they need dollars for international trade. Without this privilege, the U.S. government would need to pay market rates that reflect the true risk of its massive debt burden. Financial markets are beginning to price in these risks. Currency traders have started betting against the dollar in subtle but measurable ways. Gold prices have reached record highs as investors seek alternatives to currency-based stores of value. Major corporations are already preparing for a world where the dollar plays a smaller role. International businesses are negotiating contracts that allow payment in multiple currencies. The foundation of American economic power rests on other countries' willingness to hold dollars and dollar-denominated assets. That willingness is eroding as central banks diversify their reserves and develop alternatives to dollar-based systems. The change might happen gradually over years, or it might accelerate rapidly if confidence collapses. Either way, the privileged position that has supported American prosperity for generations is quietly slipping away. When that foundation finally cracks, the economic shockwaves won't stop at currency markets or government borrowing costs. The real devastation will hit ordinary Americans where they feel it most directly. Inflation's return with a vengeance. Rising prices would strike every American household when foreign creditors abandon U.S. debt markets. The warning signs are already appearing across multiple economic indicators that inflation could return with devastating force. Current price pressures look mild compared to what America could face if this exodus accelerates. The recent inflation spike that peaked at 9.1% in June 2022 before moderating might seem like a temporary disruption, but the underlying conditions for a much more severe inflationary crisis are building rapidly. Unlike the recent episode driven primarily by supply chain disruptions and pandemic stimulus, the next wave could stem from fundamental loss of confidence in America's ability to honor its debt obligations. A debt crisis triggers inflation through a direct mechanism that most Americans don't understand. When foreign investors lose faith in U.S. Treasury bonds and begin selling their holdings, they simultaneously sell the dollars they receive from those sales. This flood of dollars entering foreign exchange markets increases the supply of dollars while demand remains constant or falls. Basic economics dictates that increased supply with stable or declining demand leads to lower prices. In currency markets, lower prices mean a weaker dollar relative to other currencies. Currency devaluation immediately impacts every American household through higher import costs. America imports approximately $4 trillion worth of goods annually, representing roughly a quarter of the country's manufactured goods and a fifth of its total food consumption. When the dollar weakens by 10%, these imports become 10% more expensive overnight. A 20% dollar decline translates to 20% higher costs for imported goods. Unlike domestic inflation that can take months or years to work through the economy, import-driven inflation hits store shelves within weeks. The scope of America's import dependence makes this vulnerability particularly severe. Electronics that fill American homes come primarily from Asia. Clothing sold in American stores is manufactured overseas. Fresh fruits and vegetables during winter months arrive from Latin America. Gasoline refined from imported crude oil powers American cars. Even basic household items like furniture and appliances increasingly come from foreign factories. A significant dollar decline would raise prices across virtually every category of consumer spending simultaneously. Energy costs would surge first and fastest, creating cascading effects throughout the economy. Oil is priced globally in dollars, but American consumers would pay more when their dollars buy less crude oil on international markets. Higher gasoline prices increase transportation costs for every business that moves goods. Trucking companies pass these costs to retailers. Retailers pass them to consumers. Airlines raise ticket prices. Shipping companies increase freight rates. The entire cost structure of the American economy shifts upward when energy becomes more expensive. The Federal Reserve faces an impossible choice between containing inflation and managing government debt costs. Traditional monetary policy requires raising interest rates to combat inflation. Higher rates make borrowing more expensive, reducing economic activity and cooling price pressures. But the same higher rates dramatically increase the government's debt service costs. With $36 trillion in outstanding debt, each percentage point increase in interest rates adds roughly $360 billion to annual government spending. The Federal Reserve finds itself trapped between allowing inflation to accelerate or bankrupting the federal government through higher borrowing costs. This constraint represents a fundamental change in the Fed's ability to fight inflation. During previous inflationary episodes, the central bank could raise rates aggressively without worrying about government finances. Paul Volcker pushed rates above 15% in the early 1980s to break inflation, causing a severe recession, but ultimately restoring price stability. Today's Fed cannot employ similar tactics because the government's debt burden makes such rate increases fiscally impossible. Ordinary Americans would face a devastating squeeze when both debt payments and living costs explode simultaneously. Many families carry mortgages, credit card balances, student loans, and car payments that would become more expensive as interest rates rise. At the same time, their grocery bills, gas costs, and other essential expenses would surge due to dollar weakness and import inflation. Real incomes would decline rapidly as wages fail to keep pace with rising costs. Historical examples demonstrate how quickly debt-driven inflation can destroy an economy and society. Venezuela provides the most recent and dramatic case study. Once the richest country in South America, Venezuela became dangerously dependent on oil exports and borrowed heavily during boom years. When oil prices collapsed and investors lost faith, the currency plummeted and the economy unraveled. Inflation spiraled out of control, forcing people to carry bags of cash just to buy bread. Inflation exceeded 100% annually and has remained elevated for almost 2 decades. Turkey's recent experience shows how quickly confidence can evaporate in modern financial markets. Turkish officials pursued policies that international investors considered irresponsible. The lira collapsed by more than 80% between 2021 and 2023. Inflation peaked above 85% as import costs devastated Turkish consumers. Social unrest erupted as people blamed government policies for their economic hardship. These examples share common elements that apply directly to America's current situation. All involved governments that borrowed beyond their means. All experienced loss of foreign investor confidence. All saw their currencies collapse when creditors fled. All struggled with inflation that proved impossible to control using traditional monetary policy. Traditional monetary policy becomes powerless when inflation stems from currency collapse rather than excess domestic demand. The Federal Reserve's primary tool for fighting inflation involves raising interest rates to reduce economic activity. But when inflation comes from import costs driven by dollar weakness, higher domestic interest rates provide little relief. Americans still need to buy food, gasoline, and other essentials regardless of interest rate levels. Americans could face a perfect storm where multiple inflationary forces converge simultaneously. Dollar weakness would raise import costs. Debt service constraints would limit the Fed's response options. Political pressure would encourage fiscal policies that worsen the problem. Foreign creditors would accelerate their exit from dollar assets. The combination could create an inflationary spiral that feeds on itself until the government faces its most immediate crisis. The Treasury Department must continue selling new bonds every week to fund operations. But what happens when nobody wants to buy them? The Treasury auction nightmare scenario. Tuesday morning arrives with the Treasury Department preparing its regular auction of government bonds. Officials expect to raise $50 billion to fund government operations, pay federal salaries, and service existing debt. But when the bidding opens, something unprecedented happens. The major banks submit lower bids than expected. Foreign central banks that usually participate stay away entirely. Pension funds that normally compete for Treasury bonds are nowhere to be found. By the auction's end, the government has raised only $30 billion of the $50 billion it desperately needs. For the first time in modern American history, a Treasury auction has failed to meet the government's funding requirements. Treasury auctions represent the mechanical heart of American government finance. Every week, the Treasury Department conducts multiple auctions to sell new bonds and refinance maturing debt. These auctions follow a precise schedule that financial markets depend on. 3-month and 6-month bills are auctioned weekly. 2-year, 5-year, and 10-year notes are sold monthly. 30-year bonds are auctioned quarterly. The system processes roughly $20 trillion in annual issuance, constantly rolling over existing debt while funding new government spending. Primary dealers, consisting of major banks and financial institutions, are required to participate in these auctions and bid on Treasury securities. These dealers then resell the bonds to their clients, including foreign governments, pension funds, insurance companies, and individual investors. The system has operated smoothly for decades because demand consistently exceeded supply. Investors worldwide viewed U.S. Treasuries as the safest possible investment, creating reliable auction demand regardless of economic conditions. Warning signs of weakening demand are already visible in recent auction results. Bid-to-cover ratios, which measure demand relative to the amount offered, have been declining across multiple maturity ranges. The 10-year note auction in May 2025 attracted only 2.31 times the amount offered, down from an average of 2.6 times over the previous year. 7-year notes saw their bid-to-cover ratio fall to 2.44, the lowest level since 2009. 30-year bonds experienced even weaker demand, with ratios dropping below 2.2 in several recent auctions. Direct bidder participation, representing foreign central banks and other overseas investors, has fallen dramatically. These bidders typically account for 15–20% of auction demand, but their participation dropped to just 8.1% in recent 10-year auctions. This decline reflects foreign governments' reduced appetite for U.S. debt, forcing domestic investors to absorb larger portions of each auction. When foreign demand disappears, domestic institutions must fill the gap at higher interest rates to attract sufficient buyers. When the government cannot sell enough bonds to fund operations, the consequences unfold rapidly. Federal agencies face immediate cash shortages that prevent them from meeting payroll obligations. Social Security payments get delayed. Medicare reimbursements to hospitals and doctors are suspended. Military personnel don't receive their salaries on schedule. The government essentially runs out of money to perform basic functions, creating an immediate operational crisis that goes far beyond political debt ceiling fights. This funding shortage would trigger an automatic government shutdown far more severe than previous political standoffs. Unlike debt ceiling disputes where politicians eventually reach compromise agreements, a failed Treasury auction represents market rejection of government borrowing capacity. No amount of political negotiation can force investors to buy bonds they don't want at prices the government needs. The shutdown continues until either investors regain confidence or the government finds alternative funding sources. Global financial markets would react with panic to news that U.S. Treasury auctions were failing. Stock markets would plummet as investors realize that the foundation of the global financial system faces serious challenges. Corporate bond markets would freeze as investors flee to cash, uncertain about the safety of any debt securities. Currency markets would see massive dollar selling as foreign exchange traders anticipate further decline in American fiscal credibility. International banks holding substantial U.S. Treasury portfolios would face immediate losses as bond prices collapsed. European banks with hundreds of billions in U.S. debt holdings would see their capital ratios deteriorate rapidly. Japanese financial institutions would face similar pressures on their massive Treasury positions. Insurance companies and pension funds worldwide would struggle to meet their obligations as their supposedly safe Treasury investments lost value. The Federal Reserve would face enormous pressure to intervene through emergency bond purchases. Central bank officials would need to decide whether to monetize government debt directly by buying failed auction supply. This action would represent a fundamental shift from market-based debt issuance to direct central bank financing of government operations. Such money printing would risk triggering immediate inflation concerns and currency collapse, as investors interpret the policy as abandonment of fiscal discipline. Modern financial markets could make this crisis unfold with unprecedented speed. Algorithmic trading systems can execute massive sell orders within milliseconds of detecting auction weakness. High-frequency trading algorithms monitor Treasury auction results in real time and react instantly to signs of insufficient demand. Social media and financial news services would spread information about failed auctions globally within minutes, triggering immediate investor responses across multiple time zones. The interconnected nature of global finance means that Treasury auction problems would cascade through multiple markets simultaneously. Derivatives markets tied to Treasury securities would experience severe volatility. Corporate funding markets would seize up as investors question the creditworthiness of all borrowers. International trade finance would become more expensive and difficult to obtain as banks reduce their risk exposure across all asset classes. The mathematics suggest America could face a Treasury funding crisis within months rather than years. Each failed or weak auction increases investor concerns about the next one. Confidence erosion accelerates as market participants realize that previous assumptions about guaranteed Treasury demand no longer hold. When that confidence finally breaks completely, the funding crisis arrives with devastating suddenness that catches politicians and policymakers completely unprepared. The financial chaos wouldn't remain confined to American markets for long. Global economic contagions. Banks across continents would face simultaneous collapse as their foundation assets crumble. The global financial system has become so deeply woven together with U.S. markets that an American debt crisis would tear through every major economy within days. European banks present the most dangerous vulnerability. Deutsche Bank, Credit Suisse, and other major European institutions hold hundreds of billions in U.S. government debt. Their regulators have always classified these holdings as risk-free assets that don't require additional capital backing. When Treasury prices collapse during a debt crisis, these banks would face massive losses that immediately threaten their ability to meet regulatory requirements. Japanese financial institutions face even greater exposure because of their enormous Treasury holdings. Japan's major banks, insurance companies, and pension funds collectively hold over $1 trillion in U.S. government bonds. The Government Pension Investment Fund, which manages retirement savings for millions of Japanese workers, has roughly 25% of its assets in U.S. bonds. A 30% decline in Treasury values would wipe out nearly $300 billion from Japanese retirement accounts, creating a domestic crisis that forces the Japanese government to choose between bailing out pension funds or letting retirees face devastating losses. The 2008 financial crisis demonstrated how quickly problems spread through interconnected financial networks, but that crisis originated in mortgage markets that affected primarily Western institutions. An American debt crisis would be far more devastating because every major financial institution globally holds U.S. Treasuries as their core safe assets. When those assets simultaneously lose value across the entire planet, there's nowhere to hide and no unaffected institutions to provide stability. Trade relationships would disintegrate as dollar-based commerce becomes unreliable. Approximately 60% of global trade currently gets denominated in dollars, even when America isn't involved in the transaction. Brazilian iron ore sold to Chinese steel mills gets priced in dollars. Saudi oil shipped to European refineries uses dollar contracts. This system works because everyone trusts that dollars will maintain their value and remain universally accepted. When confidence in U.S. fiscal stability collapses, international businesses would scramble to find alternatives for their trade contracts. Chinese companies would demand yuan payments. European firms would insist on euro transactions. Middle Eastern exporters would explore gold-backed settlements. The process of renegotiating thousands of existing contracts while establishing new payment systems would create massive disruptions that bring international trade to a near standstill. Shipping companies that move goods between countries would face immediate crises. Their operations depend on dollar-denominated letters of credit that guarantee payment when goods reach their destination. Banks provide these guarantees based on their confidence in dollar stability. When that confidence evaporates, trade finance becomes unavailable or prohibitively expensive. Container ships would sit idle in ports because importers can't secure financing for their purchases. American allies would discover that their special relationships provide no protection from financial contagion. Canada's banking system holds substantial U.S. Treasury positions that would face immediate losses. The Canadian dollar would weaken dramatically as investors flee North American assets entirely. Australian superannuation funds managing retirement savings for most Australian workers maintain significant U.S. bond allocations that would devastate retiree wealth. European Union countries would face particularly complex crises because their banking regulations treat U.S. treasuries as Tier 1 capital assets. When those assets lose value, European banks would simultaneously face capital shortfalls that require immediate attention from their national governments. But those same governments also hold substantial U.S. debt in their own reserves, creating fiscal pressures just when their banks need bailouts. Emerging markets would experience the most severe devastation as capital flight accelerates beyond anything seen in previous crises. Countries like Turkey, Brazil, Mexico, and South Africa depend on foreign investment to finance their government operations and private sector growth. Their currencies would collapse as international capital flees back to whatever developed market assets still seem stable. Import costs would explode as their weakened currencies make foreign goods unaffordable. The speed of modern financial markets would amplify the contagion far beyond historical precedents. Algorithmic trading systems can execute sell orders across multiple countries and asset classes within milliseconds. High-frequency traders would simultaneously dump U.S. Treasuries, emerging market bonds, commodity futures, and equity positions as their risk management systems trigger automatic liquidation sequences. Social media and instant global communication would spread panic faster than government officials could respond. News of Treasury auction failures or Federal Reserve emergency interventions would reach every trading desk globally within minutes. Financial news networks would broadcast live coverage of collapsing bond prices to audiences worldwide, creating immediate pressure on every finance minister and central bank governor to protect their domestic institutions. Oil-exporting nations would face unique challenges as energy markets, traditionally priced in dollars, would need complete restructuring. Saudi Arabia, the UAE, and other Gulf states would need to renegotiate decades of dollar-denominated contracts while dealing with their own substantial U.S. Treasury holdings losing value. Their sovereign wealth funds, built on oil revenues invested heavily in U.S. assets, would face massive losses that threaten their long-term economic stability. The crisis would force a complete restructuring of international monetary arrangements that have existed since World War II. This wouldn't be a temporary disruption followed by recovery to previous arrangements. The crisis would represent a permanent shift in global economic architecture where American dominance gives way to a multipolar system with competing regional currencies and payment mechanisms. The world economy that emerges from an American debt crisis would bear little resemblance to the system that has governed international commerce for the past 8 decades. Yet despite the mathematical certainty of this approaching catastrophe and its global implications, the one institution that could prevent it remains completely paralyzed. The political paralysis problem. Congress has become completely incapable of addressing the debt crisis that threatens the entire economy. Both Democrats and Republicans have spent decades creating this problem while pointing fingers at each other instead of implementing real solutions. Every election cycle brings promises of fiscal responsibility that disappear the moment politicians face the actual choices required to reduce spending or raise sufficient revenue. The system rewards short-term thinking and punishes anyone brave enough to propose the painful measures that mathematical reality demands. Democrats and Republicans have both contributed massive amounts to the debt while claiming the other party is solely responsible. Democratic administrations expanded social programs, healthcare spending, and infrastructure investments that added trillions to the national debt. Republican administrations cut taxes while maintaining high spending levels, creating structural deficits that persisted for years after they left office. Neither party has shown genuine commitment to the spending cuts or tax increases necessary to balance the budget. Instead, they engage in theatrical battles that generate headlines while avoiding the core problem. Cutting government spending has become political suicide because every program has organized constituencies that will punish politicians who threaten their benefits. Social Security recipients vote in high numbers and oppose any changes to their benefits. Defense contractors employ millions of workers who pressure representatives to maintain military spending. Healthcare providers depend on Medicare and Medicaid reimbursements that they'll fight to protect. Farm subsidies have rural support. Urban programs have city backing. Every line item in the federal budget represents someone's livelihood or someone's benefit, creating an impossible political environment for meaningful reductions. The mathematical reality makes every year of delay exponentially more expensive. Interest payments now exceed $1 trillion annually and are projected to reach $1.7 trillion by 2034. Each year that politicians avoid difficult decisions, compound interest makes the problem larger and the required solutions more painful. A spending cut that might have saved $100 billion years earlier would need to be twice as large today to have the same impact on the debt trajectory. The longer politicians wait, the more devastating the eventual corrections will need to be. Special interests create nearly insurmountable barriers to meaningful fiscal reform. Defense contractors spend millions lobbying against military budget reductions. Healthcare companies oppose cuts to Medicare and Medicaid. Labor unions fight spending reductions that might affect government employment. Agricultural interests resist changes to farm programs. Each industry deploys sophisticated lobbying operations that make reducing their particular area of spending politically costly for lawmakers. These concentrated interests consistently defeat broader public interest in fiscal responsibility because they have more resources and stronger motivation than ordinary taxpayers. The fantasy that economic growth alone can solve the debt problem ignores basic mathematics. America's debt-to-GDP ratio reached 124.3% in 2024 and is projected to rise to 126.8% by 2026 and 128.1% by 2027. Even if the economy grew at an optimistic 4% annually, debt is growing faster at roughly 6% per year. The gap between debt growth and economic growth means the problem gets worse over time regardless of how well the economy performs. Historical economic growth rates of around 2% make the situation even more hopeless. Debt ceiling fights represent pure political theater that distracts from real solutions while making the underlying problem worse. These battles generate enormous media attention and create artificial deadlines that politicians use to score points against their opponents. But the fights focus on whether to pay for spending that has already been authorized rather than addressing the spending patterns that create the debt. Politicians treat the debt ceiling as a bargaining chip, while avoiding discussions about which programs to cut or which taxes to raise. Voters consistently reject politicians who propose realistic solutions to the debt crisis, creating a democratic trap where fiscal responsibility becomes electoral suicide. Candidates who suggest reducing Social Security benefits lose senior voters. Those who propose cutting military spending face attacks on their patriotism. Politicians who advocate higher taxes get labeled as anti-business or anti-middle class. Voters want lower debt, but oppose every specific measure that would actually reduce it. They punish politicians who tell them hard truths while rewarding those who promise easy solutions that don't exist. The political incentive structure rewards irresponsible behavior and punishes fiscal discipline. Representatives who bring federal spending to their districts get reelected. Senators who secure benefits for their states are considered effective leaders. Politicians who oppose popular spending programs are viewed as obstructionist or uncaring. The system creates overwhelming pressure to spend money while providing no meaningful rewards for fiscal restraint. Congressional budget processes have become elaborate exercises in wishful thinking rather than serious fiscal planning. Budget resolutions include optimistic economic assumptions that never materialize. Spending projections consistently underestimate actual costs. Revenue estimates assume economic growth that rarely occurs. Politicians vote for budgets that everyone knows are unrealistic because admitting the true costs would make passage impossible. The mathematics of compound interest make delay increasingly catastrophic. Every year politicians avoid real reform, the required adjustments become more severe. A problem that might have been solved with modest spending cuts a decade ago now requires dramatic restructuring of government operations. Interest costs that consume 15% of the federal budget today could reach 25% within a decade without significant changes. International examples demonstrate that debt crises eventually force political action regardless of domestic preferences. Greece, Argentina, and other countries discovered that market forces can impose fiscal discipline when political systems fail to act voluntarily. Bond markets eventually refuse to lend to governments whose debt trajectories appear unsustainable. When that happens, politicians must choose between default and immediate, dramatic spending cuts. America may need to reach the point where Treasury auctions fail and government operations shut down before politicians find the courage to make necessary changes. The current system appears incapable of voluntary reform because the political costs of responsible action exceed the benefits for individual lawmakers. Only when market forces remove the option of continued borrowing will the political calculus change sufficiently to enable real solutions. The question becomes whether America has already moved beyond the realm where voluntary political action remains possible. The point of no returns. Mathematical forces have already seized control of America's fiscal destiny. The question haunts economists and financial analysts who study the models that determine when government debt transforms from manageable to catastrophic. These models don't rely on political opinions or wishful thinking. They use cold mathematics to identify the precise point where debt service costs grow faster than the economy's ability to support them. By most credible measures, America has either reached this threshold or stands dangerously close to crossing it permanently. The debt-to-GDP ratio tells the most important part of this story. This metric compares total government debt to the size of the entire economy, revealing whether a country can realistically service its obligations through economic output. America's ratio reached 99% in 2024 and is projected to climb to 116% by 2034 under current policies. But these official projections likely underestimate the true trajectory because they assume economic growth rates and interest costs that may prove overly optimistic. If current laws remain unchanged, the debt-to-GDP ratio could reach 172% by 2054, a level that no major economy has ever sustained without experiencing severe financial crisis. Historical analysis reveals that countries typically face debt crises when their ratios exceed 90% for extended periods. Japan provides the only major exception, maintaining ratios above 200% without immediate collapse, but Japan's situation differs fundamentally from America's circumstances. Japanese citizens hold most of their government's debt domestically, creating different political and economic dynamics. America depends heavily on foreign creditors who can withdraw their support rapidly when confidence deteriorates. This external dependence makes America far more vulnerable to sudden confidence shifts than Japan's internally financed system. Current trends point toward a crisis erupting within the next few years rather than the distant future that politicians prefer to imagine. Net interest payments are projected to total $12.9 trillion over the next decade, increasing from $1 trillion annually in 2025 to $1.7 trillion in 2034. These projections assume that interest rates remain relatively stable and that foreign demand for U.S. Treasuries continues at historical levels. Both assumptions appear increasingly questionable given recent market developments and geopolitical tensions that have already reduced foreign appetite for American debt. The mathematical progression becomes more frightening when you consider compound effects. Each year of delay makes the required corrections more severe. The Congressional Budget Office estimates that interest costs totaled $881 billion in 2024, surpassing most other components of the federal budget. These costs are growing faster than defense spending, faster than education funding, and faster than most domestic programs combined. A problem that might have been manageable with modest adjustments 5 years ago now requires dramatic policy changes that seem politically impossible. Market psychology could trigger this crisis at any moment regardless of official projections or political calendars. Modern financial markets operate on sentiment and confidence that can shift rapidly when investors perceive fundamental changes in risk. Treasury markets have operated on the assumption that U.S. government debt represents zero risk, but this assumption has never been tested against the current scale of borrowing and fiscal dysfunction. The 2008 financial crisis demonstrated how quickly confidence can evaporate when market participants suddenly question assumptions they had accepted for years. Specific warning signs indicate that the final stage has begun, and several of these indicators are already appearing. Treasury auction results show weakening demand as bid-to-cover ratios decline across multiple maturity ranges. Foreign central bank participation in auctions has dropped substantially as major creditors reduce their dollar reserves. Primary dealers are retaining larger portions of auction supply on their balance sheets, suggesting insufficient end investor demand. Interest rate spreads between U.S. Treasuries and other sovereign bonds have begun widening as investors demand higher compensation for American fiscal risk. The speed at which confidence can collapse in modern financial markets exceeds anything from historical experience. Algorithmic trading systems can execute massive sell orders within milliseconds of detecting adverse signals. Social media and instant global communication spread negative news faster than government officials can respond with reassuring statements. High-frequency trading amplifies market movements by executing automatic trades based on technical indicators rather than fundamental analysis. A single failed Treasury auction or unexpected policy announcement could trigger selling cascades that overwhelm traditional market-making mechanisms. Previous debt crises offer clear patterns for what the endgame looks like when government borrowing becomes unsustainable. Argentina experienced multiple episodes where international investors lost confidence in government finances, leading to currency collapse, hyperinflation, and social unrest. Greece required international bailouts that imposed severe austerity measures on ordinary citizens, causing unemployment to exceed 25% and triggering political upheaval. Turkey's recent crisis saw its currency lose more than 80% of its value as foreign investors fled, creating import-driven inflation that devastated living standards. The Federal Reserve's options for preventing or managing this crisis have become severely constrained by the debt burden itself. Traditional monetary policy tools lose effectiveness when government borrowing costs consume such large portions of the federal budget. Raising interest rates to combat inflation becomes nearly impossible when each percentage point increase adds hundreds of billions to annual debt service costs. Lowering rates to stimulate economic growth risks triggering inflation that could destabilize the currency and accelerate foreign capital flight. International cooperation that might once have helped resolve such crises now seems unlikely given deteriorating relationships between America and major creditor nations. China's systematic reduction of Treasury holdings suggests they view American debt as a liability rather than an asset. European allies face their own fiscal challenges that limit their ability to support American borrowing. The network of central bank cooperation that stabilized previous financial crises may not function effectively when the crisis originates in the world's largest economy and most important financial market. The sobering reality is that mathematical forces have taken control of America's fiscal future regardless of political preferences or policy intentions. Compound interest operates according to inexorable laws that don't respond to election results or legislative promises. The debt has grown so large and interest costs have become so burdensome that avoiding crisis may no longer be possible through voluntary policy changes. America faces a test that will determine not just its economic future, but its place in the hierarchy of global power. The window for preventing this catastrophe is rapidly closing. This debt crisis represents far more than financial statistics. It's a fundamental test of whether America can adapt and survive as other great powers have failed to do throughout history. Your personal finances will feel the impact through higher prices, increased mortgage rates, and reduced purchasing power if the dollar loses its global dominance. The government already spends more on interest payments than on defense or Medicare, crowding out investments in infrastructure and critical programs. The decisions made in the next few years will determine whether America maintains its economic leadership or joins the long list of former superpowers who couldn't control their spending.